I'm Alan Kenny, coming to you from San Diego at REIT World 2012, NAREIT's annual convention. Joining me is Roger Waesche, President and CEO of Corporate Office Properties Trust. Roger, your company focuses on the DC area, a lot of IT agencies, government contractors. How do you see things shaping up with that group heading into the next year?
Well, that group obviously has had a cloud of uncertainty surrounding it over the past year and a half for a couple of reasons. One, the threat of sequestration, which could kick in early January of 2013. But secondly, just the overall concept of the government structural budget deficit and where defense spending and government spending overall is going to end up. So as a result of the uncertainty, our particular customer constituency has been very unwilling to make long-term commitments to space, and they've taken the opportunity to defer decisions as best as they can. So there is some pent-up demand that we expect will be realized as soon as the uncertainty over the government spending gets realized in the summer, we think, of 2013, because we do think it's going to take, after the presidential election, several months for Congress to get together and the President to sign a bill that would sort of free up the current situation over government spending. We do think, though, that there are pockets of opportunities as we go into 2013. In particular, our company is tied very much to cyber security around Fort Meade and the Baltimore-Washington corridor. And so we think, notwithstanding whatever happens with the government defense budget, that particular area will grow. And we've also seen pockets of growth down in Huntsville, Alabama, where there's certain missions that have been given appropriations that have allowed them to push forward, notwithstanding the uncertainty over the overall budget.
Tell us a little bit about your balance sheet heading into 2013. How do you feel about your overall leverage?
Generally speaking, we feel good about our leverage as we head into 2013. We've done a lot of repositioning of our balance sheet in 2012. First, we took advantage of the bank term loan market, and we extended $370 million of debt doing that. Secondly, we've sold over $300 million of assets in 2012, which is greater than the cumulative investments that we've made, so we've been able to pay down debt as a result of that. Third, we did a preferred offering in June, which allowed us to redeem a higher coupon preferred plus pay down our debt further. And then fourth, in October, we did an equity offering of $200 million, which allowed us to pay down debt. So as we go into 2013, we have zero outstanding on our $800 million line of credit, and we have very minimal debt maturities. In terms of overall leverage, over time we would like to reduce it, and we'll do that through asset sales over the next year or so.
How about new development? You've obviously raised some capital. Anything going on there?
We do think so. We've got, because of the uncertainty that's been going on with respect to the government, there has been some pent-up demand, and so we've been working with some of our customers on longer-term commitments that they've been unwilling to make. And so we think once the government budget uncertainty goes away, that we'll see some opportunities there, specifically around the Fort Meade area. We also think in Huntsville and around Fort Belvoir, where the government has missions that need to be pushed forward.
All right, and I'm going to ask you to peer into your crystal ball a little bit, look ahead to 2013 for me. What's going to be the dominant trend in the office industry?
Well, there's been a trend that's been going on for a couple of years now, one of what's called densification. That's where the amount of square footage per employee has been reducing. And there's two parts to that. One is the cyclical part, because the economy is turned down and people want to be more cost conscious. But the second is one that is more secular, where people are just trying to use less office space. And some of that is the younger generation feels more comfortable in less office space. And also, technology has allowed there to be the need for less office space per employee as we go forward. So we think that trend is a permanent trend, and one that you have to adjust your business model to. I also think that because the economy has been slow and people have been unwilling to make certain decisions, that we will see some of the pent-up demand be unleashed in 2013, and people will upgrade to the highest quality space. So I think if you're sitting with an inventory of very high quality office space, you'll do very well in 2013.
Thank you very much for joining us.
You're welcome. Thank you.
For more on this and other REIT news and analysis, be sure to check out REIT.com.